Objective number 2, explain how to identify a contract with a customer. The first step in the revenue recognition process is to identify the contract or contracts with a customer. A contract is an agreement between two or more parties that creates enforceable rights and obligations. And there are 5 criteria to identify contracts with customers. The first one is all parties to the contract have agreed to the contract and are committed to performing under the contract. The approval by the parties can be in writing, provided orally, or implied by an entity's customary business practices. 2, each party's rights with respect to the goods and services that are being transferred are identifiable. Let me say that one more time. Each party's rights with respect to the goods or services that are being transferred are identifiable. 3, the payment terms for the goods or services that are being transferred are identifiable. 4, the contract has commercial substance, meaning that the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. And 5, it is probable that the seller will collect the consideration to which it is entitled in exchange for the goods or services. To assess the probability of collection, the seller considers the customer's ability and intention to pay this specific amount of consideration when it is due. For the purposes of the 5th criterion, GAAP defines probable as likely to occur. The seller assesses collectability on the expected consideration, not the contract price. For example, if the seller intends to offer a price concession, which is a reduction in the contract price, then the estimated transaction price will be less than the contract price. Commercial substance means that the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. Here we have a problem, collectability assessment. The problem is JC Enterprises manufactures designer cases for tablets and is attempting to enter a new market with its product. To implement this strategy, JC sells 5,000 units to a retailer for a contract price of $75 each. JC is aware that this retailer is struggling financially, but is willing to enter into the contract because of his desire to penetrate a new market. Due to the financial instability of its customer, JC believes that it will need to provide a 20% price concession. So the question is, does this agreement meet the 5th criterion to determine the existence of a contract? Does this agreement meet the 5th criterion to determine the existence of a contract? And we know that the 5th criterion is collection of consideration is probable. Collection of consideration is probable. That's the 5th criteria. So the answer is yes. This agreement meets the definition of a contract. Even though it is not probable that JC will receive the full contract price of $375,000, it is probable that JC will collect a portion of the contract price for a transaction price of $300,000, which is 80% of the $375,000. If the seller receives cash before the appropriate time to recognize revenue, it should report the consideration as a liability. In addition, the entity should not remove the inventory from its balance sheet. If a seller does not satisfy all the 5 steps, if the seller does not satisfy all of the 5-step 1 criteria, then it should recognize revenue when it has received the consideration and when one or more of the following have occurred. 1, the seller has no remaining obligations to transfer goods or services, and substantially all or all of the consideration has been received by the seller and is non-refundable. Or number 2, the contract has been terminated and any consideration already received from the customer is non-refundable. Or 3, the seller has transferred control of the goods or services, is no longer transferring the goods or services, has no obligation to transfer additional goods or services, and the consideration received is non-refundable. Here we have another problem to solve. SBA Incorporated, a retail developer, sells a building to Margaret's Corporation on September 30th, 2018. The contract is $5 million. Margaret pays SBA 10% of the contract price on September 30th. The remaining 90% will be paid over the following 5 years, with $225,000 due each quarter. The first payment is due on December 31st of the same year. The payments are non-refundable. If Margaret defaults, then SBA keeps the payment that it has received up to that point, but is not entitled to future compensation. In addition, ownership of the building will revert back to SBA. Okay, continue. Margaret's intentions to open a hotel in the building. However, the building is not located in an attractive area. SBA is aware that Margaret's will have adequate resources to make the required payments only if the hotel is profitable. Accordingly, on September 30th, SBA concludes that it is not probable that it will collect the transaction price. Margaret remits the $500,000 deposit and the first 2 required quality payments of $225,000 each to SBA on December 31st. And then on March 31st, the next year, Margaret will pay the $225. On June 30th, 2019, Margaret does not make the required payment and terminates the contract. What are the required journal entries for SBA from September 30th, 2018 through June 30th, 2019? So here we have a situation. She intends to open up a hotel in the building. The building is not located in an attractive area. SBA is aware that Margaret will have adequate resources to make the required payments only if the hotel is profitable. So Margaret remits $500,000 deposit, and then there are 2 quarterly payments that are due, that was paid on on December 31st. Okay, to continue with example 8.3, Margaret intends to open a hotel in the building. However, the building is not located in an attractive area. SBA is aware that Margaret will have adequate resources to make the required payments only if the hotel is profitable. Accordingly, on September 30th, SBA concludes that it is not probable that it will collect the transaction price. So Margaret remits the $500,000 deposit and the first 2 required quarterly payments of $225,000 each to SBA on December 31st and then again on March 31st, 2019. On June 30th, 2019, Margaret does not make the required payment and terminates the contract. What are the required journal entries for SBA Incorporated from September 30th, 2018 through June 30th, 2019? What are the required journal entries? Because SBA does not consider it probable that it will collect the transaction price from the buyer, this arrangement does not meet the definition of a contract and thus must be accounted for under the alternative method. SBA will not recognize revenue until June 30th, 2019, when the contract has been terminated and all consideration it has received to date is non-refundable. In addition, on September 30th, 2018, SBA will not de-recognize the building. So the journal entries are what you see here. So on September 30th, 2018, SBA debits cash, unearned revenue is credited. On December 31st, 2018, a debit to cash for $225, that's our first payment, and unearned revenue $225. On March 31st, 2019, the same journal entry because it's the same payment amount. But on June 30th, 2019, $950 is debited to unearned revenue, and revenue is credited to $950,000. It is not uncommon for vendors to enter into multiple contracts with the same customer. Under the circumstances described on this slide, the seller should combine these contracts and account for them as a single contract. If one of the following criteria is met, the seller should combine multiple individual contracts into a single contract for purposes of determining the timing and measurement of revenue. 1, the contracts are negotiated as a package and have a single commercial objective. 2, the amount of consideration to be received by the seller related to one contract depends on the price or performance of another contract. And 3, the goods or services promised in the separate contracts are all part of one performance obligation. When identifying a contract with a customer, IFRS differs from GAAP in 2 ways. The first way is the definition of probable, as we talked about earlier and also explained on this slide. For example, Turo Company makes a sale to Milano Corporation, and Turo determines the probability of collection is 55%. Under IFRS, the 55% probability suggests that it's more likely than not that Turo will collect from Milano. Under US GAAP, a probability of 55% does not meet the likely to occur threshold. Therefore, the collectability criterion will be met under IFRS, but not US GAAP. The difference is because FASB and IASB decided to set the threshold at a level consistent with their previous revenue recognition standards and based on the interpretation of probable under each set of standards. The second difference is in determining when to recognize revenue when the 5 criteria for a contract are not met. IFRS does not explicitly include the third condition that the seller has transferred control of the goods or services, is no longer transferring the goods or services, has no obligation to transfer additional goods or services, and the condition or the consideration received is non-refundable. The FASB added this condition to clarify when to recognize revenue. The IASB did not believe this clarification was needed because the first 2 conditions should cover these cases. The IASB noted that contracts often specify that a company has the right to terminate a contract if a customer is not paying. However, for any goods or services already transferred, the company has a right to collect payment. So what is a contract? This is the end of objective 2. Check your understanding. What is a contract? A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. So our next objective 3, identify the separate performance obligation in a contract, including determining whether there are distinct goods or services. A seller needs to identify the various performance obligations in a contract to allocate the transaction price to these different performance obligations and to recognize revenue when or as it satisfies each individual one. Conceptually, a performance obligation is a promise. It is a promise to transfer a good or service that is distinct. Here you see in Exhibit 8.3, a performance obligation is illustrated here. A promise to transfer a good or service, or a bundle of goods or service that is distinct, or a promise to transfer a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. It is often clear that a customer can benefit from a product or a service on its own or in conjunction with other assets. At other times, this determination requires more judgment. If the good or service can be used, if it can be consumed or sold for a non-trivial amount, then it passes the test of being distinct. If the good or service can be used, consumed, or sold for a non-trivial amount, then it passes the test of being distinct. As an example of a readily available resource, consider a set of earbuds packaged with a mobile phone. Because the earbuds can be sold separately and can be used with other electronic devices, the earbuds are a readily available resource. Judgment may be involved in the determination of whether The promise to deliver the good or service is separate from other promises. Generally, if a promise to deliver is separable from other promises in the contract, then the two promises are not highly dependent or interrelated. Example of a free good or service. The telecommunication industry may offer free mobile phones with a service agreement. Also, the promised good or service does not have to be explicitly identified in the contract. If the customer has a valid expectation that the seller will provide the good or the service, then this item should also be assessed as a possible performance obligation. An entity should aggregate the goods or services promised in a contract until it identifies a bundle of goods or services that is distinct and thus defined as a separate performance obligation. There may be only one performance obligation identifiable in a contract. There may be only one performance obligation identifiable in a contract. Here we have a problem, example 8.4. Cred Corporation. Cred Corporation contracts with a customer to license and install payroll application software. In addition to the software license, Cred Corporation will provide installation services as a part of this contract. The installation service could be performed by other entities because Cred does not customize the software. So with this problem, identify the separate performance obligations in this contract. Identify the separate performance obligations in this contract. Okay, so the solution is Cred promises both the software license and installation service. To determine whether these are separate performance obligations, Cred needs to assess whether they meet the two conditions for being distinct. First, Cred assesses whether the customer can benefit from the good or service on its own or in conjunction with other assets that are readily available to the customer. The software license provides a benefit on a standalone basis because it is not dependent upon installation by Cred, because the software can be installed by another entity. Therefore, the software license and the installation are not interdependent. The software license and the installation are not interdependent. Cred must assess the second condition of whether its promise to deliver each of these two goods and services is separately identifiable from the other promise in the contract. In this case, because the installation service does not modify the software and could be performed by another entity, the software and installation service are separately identifiable in the contract. So the software license and the installation service are distinct goods and services, and the contract contains two performance obligations. Here is example 8.5. The problem is Cred Corporation contracts with a customer to license and install a payroll software application. In addition to the software license, Credit Corporation will provide installation service as part of this contract. The installation service customizes the software to integrate with other systems that the customer is currently using. Identify the separate performance obligation in this contract. Same company contracts with a customer to license and install a payroll software application. In addition to the software license, the company will provide installation services as a part of the contract. The installation service customizes the software to integrate with other systems that the customer is currently using. So identify the separate performance obligation in this contract. Because the installation service will modify the software and the software cannot be used until it is installed, the software and installation service are interdependent and are not separately identifiable in the contract. Therefore, the second condition for being distinct is not met. The promise to deliver the software is not separately identifiable from the promise to install. So the contract contains only one performance obligation, which is the software license and the installation service combined. And we are at the end of Objective 3. Check your understanding. What is a performance obligation? What is a performance obligation? A performance obligation is a promise to transfer a good or service that is extinct. We're going into Objective 4, which is explain how to determine the transaction price in recognizing revenue. The transaction price is the amount of consideration that the entity expects to be entitled to as a result of providing goods or services to the customer. This is the third step in the revenue recognition process, which is to determine the transaction price. The transaction price is not necessarily the price stated in the contract. Rather, it is the amount the seller expects to receive. The transaction price does not include amounts collected that will be remitted to third parties, such as sales tax. The transaction price does not include amounts that will be collected, that will be remitted to third parties. Measuring the transaction price can be quite simple in some cases. For example, assume that a customer shopping at a retail store selects and pays $100 cash for a new dress. Of course, the transaction price is $100. However, with a complex transaction, determining the transaction price is involved. However, with complex transactions, determining the transaction price is involved. Sellers consider the effects of a number of different factors when determining the transaction price, including 1, variable consideration and constraining estimates of variable consideration. 2, any significant financing component in the contract. 3, non-cash consideration. 4, consideration payable to a customer. For example, a discount for early payment typically offered by a seller is considered an element of variable consideration, even though it may not be specified explicitly in the contract. So variable consideration is when the payment received for providing a good or service is not a fixed amount. The amount of consideration may vary from a fixed amount due to price concessions, performance bonuses or penalties, discounts, refunds, rebates, and incentives. Elements of variable consideration may be stated explicitly or implicitly in the contract. If variable consideration is included in the contract, then the entity must estimate the consideration that it expects to receive using one of two acceptable approaches. One is the expected value approach, and the other is the most likely amount approach. The entity should use the approach that provides the best estimate of the amount of consideration it will receive. The entity must use the approach that best provides the best estimate of the amount of consideration it will receive. Here we have the expected value approach again. To compute the expected transaction amount under the expected value approach, the entity sums the probability weighted amounts in a range of possible consideration amounts. This method is best suited when the entity has a large number of contracts with similar characteristics. And the expected value approach is illustrated here in this example. Here is the problem. Banco Brass Corporation is a wholesaler that sells musical instruments to retailers. On February 1st of the current year, BBC contracts with Music Extravaganza Incorporated to sell 1,000 trumpets to MEI, with delivery scheduled for the month of February. The contract price is $500 per trumpet. However, the contract includes the possibility of a volume discount if the total annual purchases exceed a given amount. These discounts are as follows. So you see here, total sales exceed 1 million, you get the 1%, 2, you get 2%, 5, you get the 5% discount. These discounts are retroactive. Once volume trigger is met, BBC refunds to MEI amounts on previous purchases. BBC believes that it is 15% likely that it will not contract with MEI again this year. BBC believes the following probability estimates are accurate. On 500,000, probability is 15%, on a million is 60%, and so forth. So using the expected value approach, what is the estimate of the consideration amount in this contract? Using the expected value approach, what is the estimate of the consideration amount in this contract? In order to determine the transaction price for the contract to sell 1,000 trumpets, BBC sums the probability weighted amounts in the range of possible consideration amounts. That is, for every possible outcome, BBC multiplies the total consideration for the 1,000 trumpets at $500 each. $500,000 times the probability. It then sums these amounts to arrive at the total consideration. And here you see in example 8.6 on the next slide, continued. Thus, BBC estimates the transaction price as $493,750 for February 1st sale of 1,000 trumpets. In other words, BBC estimates the discount that MEI will ultimately receive on the 1,000 trumpets to be $6,250. The most likely amount approach uses the single most likely amount in a range of possible consideration amounts as the estimate. The most likely amount approach uses the single most likely amount in a range of possible consideration amounts as the estimate. Now, this approach is best suited when there are only two possible outcomes. Example 8.7 illustrates estimating variable consideration under the most likely amount approach. And here's the problem. We're considering BBC Corporation and MEI from the previous example. Using the most likely amount approach, what is the estimate of the consideration amount in this contract? So BBC uses the estimated consideration amount that is associated with the highest probability assessment. In this case, BBC assesses it 60% likely that the total sales volume with MEI will be between $1 and $2 million. In this case, BBC estimates the consideration amount of $495,000 for the February 1st sale of 1,000 trumpets. Now, entities must assess a contract to determine if there are any constraints to variable considerations. For an entity to include variable consideration in the estimated transaction price, it has to conclude that it is probable that a significant revenue reversal will not occur in future periods. This assessment requires the use of cumulative probability level to determine if the definition of probable or likely to occur is met. So probable is generally interpreted as 70 to 75%. This assessment requires the use of a cumulative probability level to determine if the definition of probable is met. In example 8.8 on the next slide, it provides a case with a constraining estimate of variable consideration. Here we have Calltech Company provides call center services for various software companies. Calltech entered into a contract with a customer in which Calltech will receive a fixed amount equal to $3 million under a one-year contract. In addition, Calltech is eligible for bonus payments if the average annual customer wait time is less than a target number of minutes. The bonus schedule, along with Calltech's probability assessment for each bonus, is below. At what amount should Calltech measure the transaction price for this contract, assuming it uses the most likely amount approach for measuring variable consideration? Here in this example, bonus payment 0 over 4 minutes, probability is 5%. Bonus payment of $250,000 over 3 minutes, but 4 minutes or less, there's a 20% probability. So at what amount should Calltech measure the transaction price for this contract, assuming it uses the most likely amount approach for measuring variable consideration? Now, the $3 million is part of the transaction price. Next, Calltech will estimate the variable consideration. Because it assesses a 55% probability that its average annual customer wait time will be 2 minutes or less, the estimate variable consideration is $750. However, Calltech must assess the constraint on variable consideration. Calltech must determine the probability that it will have to reverse any of the $750,000 revenue. It is 45% probable that it will receive a bonus of less than $750,000. So there is a 55% probability that it will not have to reverse revenue. It is 45% probable. That's your 5% plus the 20% plus the 20%. Probable that it will receive a bonus of less than $750,000 and thus reverse part of the $750,000 revenue. So there is a 55% probability that it will not have to reverse the revenue. So a probability of 55% is not considered probable, and thus the variable consideration is not constrained. Next, Caltech assesses a cumulative probability of 75%. That's where you get your 55 plus your 20%, that it will receive at least $500,000 for call times less than 3 minutes. Because a cumulative probability of 75% would generally meet the definition of probable, Caltech will estimate the constrained variable consideration at $500,000 per year. The estimated transaction price for the 1-year contract is $3.5 million. That's the $3 million fixed amount plus the $500,000 for the variable components. So the transaction price for the 1-year contract is $3,500,000. In estimating the constraint on variable considerations, U.S. GAAP uses the term probable, whereas IFRS uses the term highly probable. The definitions of probable under GAAP and highly probable under IFRS are essentially the same. In contracts, when delivery of the goods or services occurs in advance of the payment, the seller is providing financing to the buyer. Alternatively, in contracts, when delivery occurs well after payment, the buyer is providing financing to the seller. In determining whether a significant financing component exists, the entity considers the 3 factors on this slide. There are 1, the difference between the contract price and the cash selling price of the goods or services. 2, the length of time between delivery and payment. And 3, the prevailing interest rate in the market. The entity ultimately recognizes the transaction price as sales or service revenue and records the difference between the total contract price and the present or future value as interest revenue if the payment occurs after delivery, or interest expense if the payment occurs before delivery. Let me say that one more time. The entity ultimately recognizes the transaction price as sales or service revenue and records the difference between the total contract price and the present or future value as interest revenue if the payment occurs after delivery, or interest expense if the payment occurs before delivery. An example of a contract with a significant financing component is presented in the next slide, 8.9. And in example 8.10, it will provide you with an illustration of a scenario in which the delivery occurs after the payment. So in example 8.9, we have a problem whereas KMR Enterprises enters into a sales contract with a new customer. Delivery occurs at the date of the contract inception. However, payment of the contract price of $1 million will not occur until 2 years later. The interest rate charged in similar arrangements in the industry is 10%. Does a significant financing component exist? If so, what amount should KMR record as sales revenue? And what amount should KMR record as interest revenue? Because there's a time lapse of 2 years between the delivery and payment and the interest rate is 10%, a significant financing component exists. To compute the transaction price, which is the amount that will ultimately be recognized as sales revenue, KMR must discount the $1 million future value to the present value using a 10% interest rate. The present value of $826,446 is illustrated in this slide. KMR ultimately records $826,446 of sales revenue at the date of delivery and $173,554 of the interest revenue over the 2-year period. In example 8.10, KMR Enterprises enters into a sales contract with a new customer. Payment of the contract price is $1 million, and it occurs at the date of the contract inception. However, delivery of the product will not occur until 2 years later. The interest rate charged in similar arrangement in the industry is 10%. Does a significant financing component exist? If so, what amount should KMR record as sales revenue, and what amount should KMR record as interest revenue? Because there's a time lapse of 2 years between the delivery and the payment and the interest rate is 10%, a significant financing component exists. To compute the transaction price, which is the amount that will ultimately be recognized as sales revenue, KMR must compute the future value of the $1 million using a 10% interest rate. And it is illustrated here on the screen. The future value is then $1,210,000. So KMR ultimately records $1,210,000 of sales revenue at the date of the delivery and $210,000 of interest expense. Now, in some contracts, instead of paying cash for the goods or service, customers compensate the seller with goods, services, or other non-cash items such as shares of stock in the customer's corporation. In such case, the transaction price should be measured at the fair value of the non-cash consideration received by the seller. If the seller cannot reasonably estimate the fair value of the non-cash consideration received, then it should measure the transaction price at the standalone selling price of the goods or services promised to the customer. And here in example 8.11, we'll demonstrate the accounting for non-cash consideration. TrueTech provides a laptop-related maintenance service to Shemco. In exchange, TrueTech receives 100 shares of Shemco non-par common stock. Determine the transaction price in the contract for the following scenarios. A, 100 shares of Shemco stock is traded on an active market of $55,000 for $55,000. The standalone value of the maintenance service is $56,000. Shemco is privately held, making it difficult to estimate the fair value of the shares given in exchange for the maintenance service. So to solve this, in scenario A, where Shemco stock is publicly traded, the transaction price is the fair value of the non-cash consideration, the fair value of the stock. So the transaction price is $55,000. However, in scenario B, where the stock is not publicly traded and therefore does not have a reasonably estimable fair value, TrueTech determines the transaction price as the standalone value of the services provided. So the transaction price is $56,000. At times, a seller makes payments to a customer if the seller is providing incentives to entice the buyer to purchase or continue to purchase its goods. Unless the payment to the customer is in exchange for a distinct good or service, the seller should deduct the amount of the consideration payable to the customer from the transaction price. And in 8.2 example, you'll see where it demonstrates the accounting when consideration is payable to a customer. Here in the problem, Clever Company enters into a contract with a customer in which it promises to deliver products for a price of $10 million. The contract also stipulates a slotting fee of $250,000 that Clever Company will pay to the buyer. Manufacturers commonly pay a slotting fee to retailers to have their goods displayed prominently in the retailer stores. What is the transaction price in this contract? So to solve this, in this case, the slotting fees are not a distinct good or service that is provided to Clever Company. Clever Company should treat the slotting fee as a reduction in the transaction price, as opposed to a fee that would be expense. So the transaction price for the contract is $9,750,000. And that's the $250,000 from the $10 million. And that's how you get the $9.7 million. Here in Exhibit 8.4, it summarizes the process of determining the transaction price. Again, the transaction price is the amount the company expects to be entitled to as a result of providing goods or services. You have your variable consideration, a financing component, non-cash consideration, and then the consideration payable. This is just a summarization as to how to determine the transaction price. And here we are at Check Your Understanding Objective 4. The question is, what is the transaction price? What is the transaction price? In other words, the question is to find transaction price. The transaction price is the amount of consideration that an entity expects to be entitled to as a result of providing goods or services to the customer.